Hello and welcome. I'm Financial Standard Editor Mark Smith, and today I'm joined by Panagora President and Chief Executive Eric Sorensen, and we're here to talk about the fund's Pengana Panagora Absolute Return Global Equity Strategy. Hi Eric, thanks for joining us.
Thank you, it's just a pleasure to be here, thank you.
So Eric, you guys have been managing money here since 2006. I think a lot of Australian clients may not have heard of you. Can you start by telling us a little bit about the firm?
That's a good question. We are a firm that's primarily institutional, meaning we have large pension plans and superannuation and governments as well as public funds. 30-year-old firm, quantitative in nature, although that's a very broad term, and quite innovative. We have a team of about 40 investment professionals, many with backgrounds that are advanced degrees, and we do a lot of modeling, and it's our innovation that really drives the results. We have a variety of products. Equity products and also some hedge fund-like products.
So the fund you guys are managing from Pengana would be described as an alternatives fund. What are alternatives and why have they become such an important part of a well-constructed portfolio?
I wrote a paper several years ago describing the future of active management, and I noted that in 1970 everything was alternative. In other words, professional money managers were given mandates to make money for their clients. A former academic for 14 years, I'm well aware of all the evolution of the modern financial techniques, many of which have a big impact on the way the world moved in the financial markets. So the cap-weighted, long-only equity index is an elephant. And anything other than that, I would call a alternative. So it's a very broad term. I think you'll see much more absolute return, private equity, other strategies of asset allocation that are far different than just being long cap-weighted indexes around the world.
Well, can you tell us about the Pengana Panagora Absolute Return Global Equity Fund?
That fund we've had it for a few years, and we've been fortunate to associate ourselves with Pengana, who's helping us here in the local market. It is a long-short equity portfolio. It has some leverage in it, so we will leverage the long positions, maybe 2 or 3 to 1, as well as the short positions. But it's got no beta. It's impervious to oil shocks, market moves, all kinds of externalities. And it focuses on inefficiencies within the markets, global equity. The large portion of it is a model that we have which forecasts maybe returns out 6 months using a variety of quantitative inputs. We also have some shorter horizon components, 3 to 6 months. We do merger and acquisition in that and other things like that. And we have some very short-term positions as well based on news events, things we get from the media, web crawling, and so on.
So you refer to differentiation of your firm there, but aren't all quantitative strategies basically all the same?
Basically in 1985 or 6, I left academia and went to work at Salomon Brothers as the head of quantitative research and produced the first large cap US quantitative model for index enhanced strategies, which was later copied by a number of buy-side clients of ours, which was fine. I think there was a period there where there was a lot of homogeneity and it continued on. So in those days, right, there was a lot of similarity, even carrying into the early 2000s. And the quantitative meltdown that happened in long quantitative product in 2006, 7, and 8 during the global financial crisis is evidence that there was too much money and too few alpha sources. We did very well in that environment because we have a number of things we do differently. The AUM in that space is half what it was today than 2007. Our AUM in that space has gone up 4 or 5 times. So we are quite different.
And Eric, perhaps you can give us an example of one of those unique factors or models that you guys introduced into the strategy.
Well, the basic model, which really is has the most exposure in it in the 1,000 stock long-short portfolio, has a 6 to 9 month horizon. And some factors we put in there are generic for all companies. For example, we actually have a score on the quality of the board of directors of every company. You can actually do that, and there are interesting ways to do that. We have a score on basically the compensation scheme of senior management. So we're looking for quality companies that are well run. That applies everywhere. Then there are a number of sectors that we will look at very deeply, much the way a fundamental analyst would think if they're picking 3 or 4 good stocks in, say, aerospace, in technology, in medicine, and so on. Give you an example in transportation, in airlines. It's a fairly simple concept, but if you go back and test the following, airline stocks that have the largest incidence of lost luggage are underperformers. It's just a good signal. And those that don't lose luggage, they're better companies, and they appreciate better in value. And we have ways of quantitating those things. And there are many other examples. We have a way of looking at financials to actually value the balance sheets. Rather than a PE ratio or price to book of a large bank, we actually are inside their book of business and look at the quality of the loans they have. And you can get that data electronically. So if you think about what we do, a fundamental analyst really will try to comprehend what he or she thinks is the perfect stock. What we do is build a comprehensive system and try to perfect it so that it can actually capture some of the essence of the way people think. Everything we have is cause and effect. It's not a black box. Physics, pure physics, if that's what you're doing, it's going to be hazardous to your wealth. So it's quantitative, but it's heavily driven on basic fundamentals.
And finally, what happens when you put all this together? What's the net result?
The net result is the long-term model will drive most of the portfolio. It's got about 50 or 60% of the risk and return. The shorter-term models are somewhat opportunistic. If there's a lot of M&A activity, we'll have a sleeve along the target companies. But rather than buying just a few, like a fundamental manager, we'll buy a collection of them which avoid the ones that don't have a good payoff or that probabilistically may not succeed. We model that quantitatively. And then there's a very short-term model that we look at all kinds of interesting information about companies. For example, if a CEO announces that they want to have an analyst day where they talk to all the security analysts, it's voluntary, they're not going to say bad things. So we have databases that would collect that in advance, and you can make a 1 or 2 day return on the anticipation those analysts are coming back and write positive reports. That stuff gets arbed away, so you have to continually look for that type of input and improve the model. There's 1,000 positions in this portfolio, long and short, totally balanced, no country exposure. Any stocks we have in Germany, we have an equal amount short, no currency exposure at all to speak of, and so it's just purely based upon finding a collection of securities which are going to go up more than the others and going long some and short the others. The result is a double-digit return on average over time, even north of that, and less volatility. So say 8 to 14% annual return, and compared to what you get in the bank, that's pretty good, but it's volatile. The volatility might be 4 to 8%. So the ratio of return to volatility is pretty attractive. So it's not guaranteed, but in the low return environment, it's a terrific investment strategy in a low return environment that we're in. You have to find things you can do, and this is a good one.
Well, Eric, thanks for joining us. It sounds like a really interesting strategy, one that would be perfect for this kind of market.
Thank you very much. I really appreciated being here. It's a pleasure. Thank you.
And thank you for joining us here on FSI TV. We'll see you next time.